Welcome to the Wealth Blueprint Desk, where we provide research-based dividend ETF and passive income analysis from public 10K filings, expense ratios, and historical performance data. Today, we're going to explore the topic of building a wealth blueprint with dividend ETFs. Research shows that dividend investing can be a powerful way to build wealth, with the potential for long-term growth and income. For example, this ETF has a dividend yield of 3.5% and an expense ratio of 0.06%, making it an attractive option for income-seeking investors. Additionally, the Schwab US Dividend Equity ETF has a dividend yield of 3.1% and an expense ratio of 0.06%, making it another option to consider. According to a study by Fidelity, dividend investing can provide a relatively stable source of income with the potential for long-term growth. The study found that dividend-paying stocks have historically outperformed non-dividend-paying stocks over the long term. In fact, a study by Morningstar found that from 1970 to 2020, dividend-paying stocks returned an average of 10.4% per year compared to 8.4% per year for non-dividend-paying stocks. Data indicates that the S&P 500 tech weight is approximately 28%, which can impact the performance of your portfolio. We analyzed the historical performance of the VOO ETF, which has a dividend yield of 2.1% and an expense ratio of 0.03%. Our analysis suggests that this ETF can provide a steady income stream and long-term growth potential. For instance, if you invest $10,000 in the VOO ETF, you can expect to earn around $210 in dividend income per year, based on the current dividend yield. Consider a scenario where you invest $500 per month at a 7% annual return over 30 years, resulting in a significant accumulation of wealth. According to the IRS publication 590, dividend income is taxable, but the tax rates are generally lower than those for ordinary income. For example, if you're in the 24% tax bracket, you may be able to reduce your tax liability by investing in dividend ETFs, as the tax rate on qualified dividend income is 15%. For instance, if you invest $500 per month for 30 years, you'll have contributed a total of $180,000. However, with a 7% annual return, your investment could grow to over $2 million, providing a significant source of passive income in retirement. To put this into perspective, if you retire with a $2 million portfolio and earn a 4% annual return, you can expect to earn around $48,000 in passive income per year, based on the 4% withdrawal rule. The Federal Reserve survey shows that many households are not saving enough for retirement, and dividend ETFs can be a valuable tool for building a secure financial future. We will also explore the benefits of using dividend ETFs in a tax-advantaged account, such as a 401(k) or IRA. According to a report by the Employee Benefit Research Institute, nearly 40% of workers are not saving for retirement. By using dividend ETFs in a tax-advantaged account, you can potentially reduce your tax liability and increase your retirement savings. For example, the VYM ETF has a dividend yield of 2.9% and an expense ratio of 0.06%, making it an attractive option for income-seeking investors. Our analysis suggests that dividend ETFs can be a powerful tool for building wealth, but it's essential to approach them with a comprehensive strategy and a long-term perspective. As noted by John Bogle, the founder of Vanguard, the key to successful investing is to have a long-term perspective and to avoid getting caught up in the short-term fluctuations of the market. We will break down the benefits and risks of dividend ETFs, including their expense ratios, dividend yields, and sector concentration percentages. We will also discuss how to use dividend ETFs to create a comprehensive wealth-building strategy, including how to diversify your portfolio and manage risk. For instance, the JEPI ETF has a dividend yield of 3.1% and an expense ratio of 0.12%, making it an attractive option for income-seeking investors. However, it's essential to consider the potential risks such as sector concentration and interest rate risk. According to a report by BlackRock, dividend ETFs can provide a relatively stable source of income, but they can also be subject to interest rate risk. As interest rates rise, the value of dividend-paying stocks can decline, potentially reducing the income stream. To mitigate this risk, it's essential to diversify your portfolio across different asset classes and sectors. For example, you could invest in a combination of dividend ETFs, such as the VYM ETF and the SHT ETF, to spread out your risk and increase your potential returns. Whether you are a seasoned investor or just starting out, this video will provide you with the knowledge and tools you need to build a successful wealth-building strategy. According to BLS data, the median household income is around $67,000 per year, and investing in dividend ETFs can help you grow your wealth over time. Per IRS publication 590, dividend income is taxable, but the tax rates are generally lower than those for ordinary income. For example, if you earn $67,000 per year and invest 10% of your income in dividend ETFs, you could potentially earn an additional $2,000 to $3,000 per year in dividend income, depending on the dividend yield and expense ratio of the ETF. This can be a significant source of passive income, especially if you're able to reinvest your dividend income over time. The Federal Reserve survey shows that many households are not saving enough for retirement, and dividend ETFs can be a valuable tool for building a secure financial future. We will also explore the benefits of using dividend ETFs in a tax-advantaged account, such as a 401(k) or IRA. According to a report by the Investment Company Institute, tax-advantaged accounts can provide significant tax benefits, potentially reducing your tax liability and increasing your retirement savings. For instance, if you contribute $5,000 per year to a traditional IRA, you may be able to reduce your taxable income by $5,000, potentially reducing your tax liability. This can be a significant benefit, especially if you're in a high tax bracket. Additionally, the money in your IRA will grow tax-deferred, meaning you won't have to pay taxes on your investment gains until you withdraw the money in retirement. In conclusion, building a wealth blueprint with dividend ETFs requires a thorough understanding of the benefits and risks of these investments. By diversifying your portfolio, managing risk, and taking a long-term approach, you can create a comprehensive wealth-building strategy that generates passive income and grows your wealth over time. As noted by Warren Buffett, price is what you pay, but value is what you get. By focusing on the long-term value of your investments, rather than the short-term price fluctuations, you can build a successful wealth-building strategy that will last a lifetime. The biggest takeaway from this video is that dividend ETFs can be a powerful tool for building wealth, but it's essential to approach them with a comprehensive strategy and a long-term perspective. By doing your research, diversifying your portfolio, and managing risk, you can unlock the full potential of dividend ETFs and build a secure financial future. If this video has provided you with valuable information and insights, hit subscribe. We're covering the topic of tax-advantaged accounts in our next video, dropping next Wednesday. Ring the bell so you